Oh, there you go. Yeah, cool. All right. Cool, man. Welcome
Yeah,
aboard, Amar. Been a couple
here
weeks.
we go. All right, so today we are going to be talking about uh, tax planning and potential changes.
Yeah.
And while we're waiting for everybody to get in here, Josh, I'm just going to go do my disclosures real quick.
Yep.
Three key parts of our disclosures. Number one is we haven't taken your specific situation into account. Number two, this is strictly educational, and we haven't entered a client uh, agreement in this. So just the key stuff of making it all educational here. The purpose of today's conversation is really to see where are the tax tables today, what are potential changes coming up. I think you know in the world that we're living in, things are constantly changing, it seems, but taxes is a big piece of that. And want to highlight some potential planning opportunities if we could do things earlier or versus later. And so we're going to get into it. Josh, you have anything to add?
No, man. Just keep going. Absolutely.
All right. So is this coming on across full size? Because on my side it's not. I
It's
don't
full
know.
size. Yeah, it's coming full size. Yeah.
Okay. So here is the current income tax tables, right? And what I want to highlight here is that, remember, before the Tax Cuts and Jobs Act, these tax rates were different, right? It was 10, 15, right? That there's actually there's an extra one in here, and so these could be changing, right? And so what happened with the current tax code is that they made each one of these brackets wider, meaning that let's say, for example, the 10% tax bracket was wider, and we removed one of the tax brackets. So we could have more brackets and we could have less room in each bracket, right? So that's something to be aware of. From a trust and estate planning perspective, right, I think it's very important to kind of look at this. If you own an irrevocable trust, these are the tax tables that irrevocable trust is paying. If you're an income beneficiary of a trust, irrevocable trust from that's been set up, this is the taxes that trust is paying, and on the 1041, right? And usually these numbers stay about the same in terms of the thresholds matching an ordinary income tax rates, but the key thing to look at is retained earnings that are in excess of 15,000 is taxed at the highest tax rate.
Exactly.
So these trusts need to distribute the income. We got IRMA calculations. This is the new brackets for 2024, right? So one of the things I think is really important is if you're considering Roth conversions, is not only to look at this earlier slide of the tax tables right here where you fall within these, but also where you fall within these IRMA brackets as well. So there's two sets of brackets that you want to be cognizant of. So this is a big one: standard deduction and personal exemption, right? One of the big changes was with the Tax Cuts and Jobs Act is they made the standard deduction so large that a lot of people didn't have to itemize anymore, right? And so you can see here for 2024, the standard deduction for a married couple is $29,200, right? Most people average itemized deductions are right around 20,000. So, it's probably better to just do the standard deduction, right? This could be like TurboTax easy, if you will. Reminder, if you're above age 65, there's an additional deduction that you can take from the standard deduction side. So these could potentially change, right? So the personal exemption went to 0. And the standard deduction went up. If we go back, then the standard deduction could drop and the personal exemption could come back. and maybe even the SALT cap, the state and local taxes cap, could be removed, right? Josh, do you have anything to add, or?
Well, I'm just trying to comment here, but I would say on this right here. So don't forget, guys, the standard deduction basically doubled, and they got rid of the personal exemption. All right, so they're going to get rid of if Trump loses or the TCJA just expires, the standard deduction will be cut in half, and the personal exemption will come back, but it's not nearly enough to cover the loss of a standard deduction. So all these idiots out there saying, "Oh, I pay more taxes on the Trump," they're just wrong. Other than the SALT, and I think you're going to talk about SALT here in just a second, Amar.
Yeah, I mean, I just mentioned that the cap may be removed.
Okay, so SALT's a state and local taxes, and that's a $10,000 cap, and that would be removed. If Kamala wins, that's going away. There's no other way around that, because the SALT affects mostly the blue states, which is her base. And so you could see that people in New Jersey, New York, and whatnot would be that they could see maybe not a tax increase under getting rid of TCJA, but certainly they'd have more deductions which they could file than they do now. That's for sure. But we'll see. It's all like Amar said. It's all contingent on the future. We just don't know.
Yeah. This is a big one in AMT world, right? Like the amounts, the thresholds were expanded, right? So they all got bumped up, if you will. But it removed specific things with incentive stock options, right? And so being able to deduct like kind of the basis there, you can't do that. That's a preference item here. And so remember, there's two tax rates with AMT. It's 26 and 28%. And so that phase out of those, what you would do with stock options may impact you from a planning perspective.
Oh, it's just going back to Roth Conversion, go back to AMT. I mean, AMT it engulfs more and more people because it wasn't adjusted for inflation. I paid AMT in 2017. It freaking ticked me off. And so the issue is that if you do Roth conversions of any significance, you could be in AMT. That's just a fact. So we have to see.
Long-term capital gains. So this is 2024, and these are the numbers for the 2024 tax year. For the most part, most individuals will be in the 15% tax rate. Some individuals will be 20%, and then even fewer than that would be in 23.8, right? If you hit one of these thresholds here, there is a surcharge, the net investment income tax. So one of the things that's been thrown out there in terms of potential change is that these numbers could line up more or closer to the income tax table, right? So these numbers, as you see, like for example, 15% is 94 to 583,000. Well, that could maybe change to be closer to the income tax table.
Yeah.
And if you're a small business owner, QBI is one of the things that you can use to get a 20% tax-free income on your business. This threshold numbers this is the start of the threshold, right? It phases out after these numbers here. If you do phase out, then you can't do a QBI, but potentially QBI could go away, right? Yep. And so that's something else that you have to consider.
That's a big tax increase for small business owners right there.
Yeah. Sure. And I think the other part that's a big change is that accelerated depreciation on business property. I think it was section 179 where most business owners were using cars to kind of get the accelerated depreciation or, equipment. That's fully phased out, at the end of this. So something else to consider.
Yeah, another business owner hit. We're going to have net capital gains on unrealized appreciation. No. Phase out 179 depreciation and bring back AMT and get rid of QBI. Woo! But hey, it's no tax increase.
Right. Healthcare has a lot of different numbers in here. A lot of these do get adjusted, right? So if anything, I think all these numbers would go up in terms of how much you can contribute to an FSA, HSA. These numbers, tend to stay inflation adjusted and fairly stable. Retirement plans. Now, retirement plans have had a lot of changes since the Secure Act. So let's talk about a couple of the big changes real quick. The first big change is beneficiaries, right? There's no longer the stretch ability of an IRA unless you're a spouse, right? So if you have children and they inherit your IRA, they have 10 years to make those distributions. And now there's a required minimum distribution in each one of those 10 years, right? So you can't wait till last year and then distribute it all. The dollar amounts that you can fund into the retirement plans have also changed. They all gone up, inflation adjusted, whatnot. Now you can do $8,000 into an IRA. I remember when I first started my IRA, the max you could do was $2,000, right? So those numbers have definitely gone up. They've also solidified if you have a 401k and you're funding that 401k pre-tax and you have an after-tax option, you can fund that after-tax option and then convert that at the end of the year or periodically throughout the year to a Roth 401k or a Roth IRA. And those mechanics are now kind of solidified, if you will. But yeah, making sure that you maximize these contribution amounts to reduce your tax bill. I think that's fairly important. Anything else to add to this, Josh?
No, nothing there. Yeah, absolutely.
Yeah. So the next one is estate planning. And I think this is the part which is like the biggest bargaining chip because, both sides of the aisle have rich donors, right? And donors are really impacted by these type of things. And right now, the gift and estate tax exemption, when the Tax Cut and Jobs Act started, bumped up to 11 million, inflation adjusted, sunsets in 2026. So, 2025 is the last year that, this inflation bump happens. If nothing happens in 2026, it reverts back to 5 million inflation adjusted. So roughly it would be about half, right? Like somewhere around 6 million. And so there are two areas where this could be impacted, right? The portability of it, the exemption, right? So making sure that your trust documents have that. So if it drops down to 6 million, and you're even saying, all right, my overall estate will not go above, 10 million, whatever, you still want to make sure you maximize the gift tax exemption amount for each spouse. Secondly, the annual gift tax exclusion, which is $18,000 per person per beneficiary, that could be capped at $50,000, right? And so, and that's something that's been talked about over and over again. But essentially, one person can gift $18,000. The spouse could give $18,000. So a beneficiary could get $34,000 a year from, parents. If you have 3 or 4 kids, that's significantly higher than the $50,000 amount, right? So if there's, some planning to be done, this is the right years to get that done and be proactive with that.
Don't forget, I just want to point out, guys, the estate tax, I know it sounds like a lot of money at $5 million, but one thing I think people forget, and even though they did inflate this, index it for inflation now, let's say you have an estate of $3 million today, and let's just say you get a simple 7% compounding. So in 10 years, your estate is $6 million. All right. Now, what will the inflation on the $5 million grow to? We'll say $7 million. All right. So just hear me out. In 20 years, your estate is $12 million if you have simple 7% accounting and in that compounding, and your estate exemption hasn't grown that high. And as such, now you have an estate tax. So everyone says, oh, that doesn't bother me. Might not bother you now, but could easily bother you 20 years from now with just basic compounding that's well above the rate of inflation. And if you just look at history, any 25-year time, going back to 1926, just a 50-50 stock to bond market has beaten the rate of inflation significantly. any 25-year time. It's not even close. And so the likelihood that you don't have an estate tax, well, it's low. It creeps up on you, man. It does. And a lot of people, Amar, have dismissed the estate. And I get it because we haven't had to talk about it since 2017. But that's a big one right there. And on top of that, guess what? Life insurance, if you own it, is included in your estate. Amar, I can't tell you how many people think that's not true. If you own the life insurance policy, it is included in your estate. It's just a fact. And that could be a big ticket item right there for sure.
Yeah. So making sure the titling is correct on your life insurance and
100%.
Other policies. Most of the life insurance policies you typically buy when you're young and you have young kids, right? So you're trying to cover income. But those permanent policies have an unintended consequence of being added to your estate. And most of the time, if you're looking for a policy that you want to get excluded out of your estate, you really need to set up an irrevocable life insurance trust. And then that gets it out of the estate. Next slide here is just kind of a brief summary, right? So the highest tax rate now is 37%. Potentially could be 39.6, right? Your gift tax exemption right now is 13 million something, could decrease to 5 million inflation adjusted. Standard deduction doubled, right? Right now, personal exemptions are eliminated. Those are all going to come back with SALT deductions potentially removed. Yeah. QBI we talked about. And then, we're going to revert. We have higher phase out thresholds now, but we've eliminated some of the things that were deductible. But now we may go back to the lower thresholds and some of those things being deductible. So all to say that a lot of things could potentially change. Here are some 10 planning scenarios that I want to cover. Okay. Before we cover these, Josh, I'd just like to do a shameless plug. If you like this type of information, go over to Client First Capital Learning. It's a YouTube channel. Please give us a like and a follow. It helps other people find this content. If you have questions about your specific scenario or concerns that you want to address, you can reach out to us directly at clientfirstcap.com. But let's get into these 10. So the first thing is stock options. You got to understand where you fall within the AMT phase outs to understand how much of those exemptions that you want to exercise and actually sale of the stock, because the AMT calculation will have a big shift, right? You may get more deductions if you hold off, but if you're in the middle of the AMT, you may be paying a higher, like more of the 28 versus the 26% piece there. If you have concentrations in a one security or a business, you may want to look at the timeline selling those assets or diversifying, because capital gains and tax rates are lower now. Those could potentially change in the future. Roth conversions, obviously you want to see where you're at between the IRMA tables and the tax tables, but they tend to probably make more sense today than they will in the future. Where you hold your assets. Yeah. Right. So if you have income coming from a bond, if you have that in a taxable account, that's tax at ordinary income. Yep. Versus if you have that bond in your IRA, the exact same bond, that's, you get taxed when you make distributions. And then you could probably take advantage of long-term capital gains in your taxable account. So in the taxable account, you want to think about taking advantage of long-term capital gains, maybe buy and hold type securities. Absolutely. Higher transactional securities or interest-paying securities, dividend-paying securities, maybe in an IRA. And then growth type stocks or funds in a Roth IRA. The location of those assets matter. And Josh, one thing that just really drives me up the wall, and you'll probably agree with this, is that sometimes if you go to a big financial institution and you tell them that you're moderate, you're going to have the same allocation in each one of your accounts. Yeah, 100%. And that's a big disservice from a tax planning perspective, right? So you can do better, right? Amar had a lady who she was a moderate investor, and they had her 50-50 in her Roth,
her traditional brokerage account. I said, no. And I said, we want the Roth to be growth and just what we're talking about. Vanguard literally read her the right, not literally, they basically read her the riot act. They said, no, you're a moderate aggressor. You're a moderate investor. They need to be 50-50. She goes, I still want to be 50-50. I just want to be 50-50 in a tax efficient manner. And it was like literally for days, she was arguing with Vanguard. It's like, dude, it's your money. It's not theirs. It's crazy, man.
Yeah.
Hey.
So,
just a side note, and I don't know how I got to make sure I'm not being perceived as anything, but side note, if you have a money manager and he's not allocating your assets in the proper location, as Amar just talked about, you may want to reconsider that money manager, because that's just lazy portfolio management. If you're paying a fee, there's no excuse to be lazy like that. You can't be, I mean, Vanguard's one thing, that she was in the personal financial advisory service. It's not hugely expensive, but it's expensive. But I'm just throwing out Fisher, for example, not bashing the guys. If you're a Fisher and they got you a 50-50 in all three types, that's just the wrong answer. And you need to find someone who's not going to be lazy. Anyway, keep going, Amar.
Yeah. So, obviously maximize employee benefits to reduce your taxes as much as possible. Also use it for tax planning for the future. Remember, you can do pre-tax. You can maximize your pre-tax 401k, contribute to the after-tax, convert that to a Roth. I have somebody that's doing it on a monthly basis. That may be a little bit excessive, but you can do it quarterly or yearly. But essentially, you're able to transfer those after-tax dollars into a Roth 401k, Roth IRA. Delay harvesting of losses. This is something that we're talking to some people about. I know it's common to say, hey, do every year, check your tax loss harvesting. You really want to do tax loss harvesting when you have a large capital gain to offset, or you want to do tax loss harvesting when you get the biggest bang for your buck. And, potentially delaying it when tax rates are higher, you're going to get more utilization of the same losses, for dollar. One thing, for people that have larger estates, say, 10 million plus, is consider setting up irrevocable trusts and using some of the exemption amounts now, right? So if we have 26 million in exemption amounts now, not saying you use all of it, but we know it's going down to 12, you're not going to get any of that between 26 and 12 back.
Right, exactly. 100%.
Right. So if you use 14 million of it, you're still at zero.
Right.
Versus 12. So that is something to consider.
Great point, Amar. I know this seems like 26 million. I get it, but man, that 14 million, if it goes down, it's gone forever. And you could use. I know this is probably no one on here has got that kind of net worth, but just think just a little bit outside the box for people who are bordering on it. Amar, I'll never forget. I had a hedge fund guy in New York State. He had $20 million net worth, and he was making bank. And I said, dude, you're gonna get hammered in estate. This is back in 2010. I said, you're gonna get hammered estate taxes. Well, why would they do that? I said, because you got all this money. He was like, no. I said, okay, all right, idiot. If you don't think so, I'll never forget that guy. I said, all you got to do is some basic estate planning. You don't have to do anything fancy. It was amazing how few people think they're going to get a subject to estate tax. It's amazing to me, actually.
Yeah, and I think from a planning perspective, the easiest thing to do is say, hey, how much do I need for my needs?
Exactly.
How much is going to be legacy or safety, part of that component, and maybe consider making annual gifts now to help the children, right? I know I misspelled this here, or there's not an F here, but it's supposed to be annual gifts, right? So that 18,000 that you can do this year, next year it'll go up one last year, and then it's if nothing changes, it reverts back to old numbers, or
lower. We don't know.
Or capped at 50,000 per family, right?
That was in the Biden tax plan, my friends. That's Amar didn't pull that out of his butt. That's literally in the Biden tax plan of 50,000 per family.
Yeah. Delaying and bunching charitable gifts, right? I think this is key. Is if tax tables go higher, you want to gift when the rates are high to bring your taxes lower. Maximizing those charitable gifts by bunching them up. So most people itemize. You could do standard deductions, and then for the years, and then itemize in 1 year, put a bunch of money in a donor advised fund and then gift from the donor advised fund to charities. And then business owners, business owners may consider selling earlier, like accelerating some of the sale. You don't have to sell the whole business. You can sell parts of the business, right? To be in this more favorable tax environment. I think, so we got all this, we didn't create these slides. We read
Got a couple of questions here, Amar.
Yeah. So let me close this here.
Yeah.
Let's go.
You have access to the comments?
I do.
Okay.
So I'm going to start from the beginning here.
Yeah.
So,
well, there's a couple actually questions I want you to address here.
Yeah. So let's go through them together here.
Right here. So look at Stephen Haggerty's first. That's a question.
Can you see the screen, Josh?
I can see it's Jill.
Yeah. Hopefully they get extended. Hopefully they get made permanent. Nobody knows. Nobody has a crystal ball. I would just say the deficit continues to grow. And the one source that the government has to pay the interest payment is taxes. So I guess we'll see.
See, it's Stephen Haggerty.
I'm reading through these. So this one says 50K tax deduction for small business last night. Yeah, that's what she has said. That's true.
I'm betting the bank on that.
Yeah. 22 to the 28% bracket if they do nothing, right? I mean, this is what you have 2 years to do something. So to take advantage of the lower tax rate. And Josh, we should probably say, historically speaking, 20% has been a good average tax rate. Right. When you not what tax rate you're at, but if you add up all your taxes,
effective tax rate,
divide it out, your effective rate. Yeah. If you're between 15 to 20%, that's typically considered good. Let's see. There's somebody checking in from Minnesota. I just got back from Stillwater, Minnesota, Twin Lakes.
They kicked Amar out of there. They said, we don't want you around here anymore.
If you ever go to Minnesota, go to Nelson's Ice Cream. I swear, like a small ice cream was bigger than this jug of water. Yeah.
How much it cost?
Like $4 or $5. But like my kids went to town.
Man, that's what I'm talking about. Yeah, look at that next.
All right, here. Qualified dividends are added to annual income or is kept as separate. So qualified dividends, do you want to go over this, Josh, or do you want me to?
Yeah, go ahead, Amar. Absolutely.
Yeah, so like, they get taxed at the capital gains rates, right? So like the capital gains rates table is what they'll be taxed at. They get added to your total income, but they're not on the your what's called marginal income tax table.
Yeah. So that was going back to the $5 million exemption for estate tax. If they lower that will screw farmers.
Yeah, for farmers, yeah, that could be.
Just let me address that real quick too, Amar. Another thing that ticks me off: if you're a farmer and you have a bunch of land, the one thing you don't have is a lot of liquidity. And so if you get subject to an estate tax, how do you have the liquidity to pay the estate tax? And the only way you do it is you got to either have you're dead, your kids sell the farm for a fire sale, or you set up an irrevocable life insurance trust, and a trust, ILIT, like Amar was referring before, where you create an instant liquid estate. I cannot stress the idea, the estate tax, it's no big deal. I got $8 million of net worth. If 7.8 of that is in real estate, you don't have any liquidity to pay the estate tax. And this is just for the federal. If you live in Massachusetts or Oregon, other states,
Washington,
man, I think Minnesota too. I think, this is no joke. And yet people are like, it must be nice to have those problems. I was like, man, dude, crazy. Really bothers me, man. Anyway, keep going.
All right, estate tax, or that's just as a concept. I clicked on the wrong one here. Somebody asked about Roth conversion, Roth IRAs included
in your estate. Yeah.
Here it is. Sorry. Roth IRAs included in estate tax. Yeah. I mean, IRAs, Roth IRAs, taxable accounts are all included in your estate. Here's the difference, though. IRAs and Roth IRAs transfer by operation of contract, not operation of law. So you have named beneficiaries on Roth IRAs and IRAs, right? So that, although it's included in your overall estate, those transfer by operation of contract. Unrealized gains, Josh, you just talked about that.
That's never going to pass. I don't care what, but there's no way. That'd be insane.
I think this is more of a gripe here.
Exactly.
All right, here. So the estate tax reverts back to $5 million. If you have $6 million, $1 million is taxed at 40%. Yes. Yeah. Now, if you're married filing jointly, you each have $5 million. So then you have a $10 million exemption, right?
But remember they used to have to engage in the portable. Remember, it used to not even be portable, Amar. So you do a Q-tip to. I don't want to get to it, but
yeah. So what Josh is saying is that in 2014 there was new language that you should have in your trust that makes the portability of the passing of the first spouse, the portability of unused exemption to be added to the surviving spouse. So
and
if you have any trust,
yes, go ahead. Keep going.
If you have any trust documents, you want to make sure that that language is in there.
Absolutely.
I
think we got another one. Maybe not. I thought. Okay, I guess that's it. The rest is just on health insurance. Oh, thoughts on MLPs? Oh, here you go.
So my UBS guy says tax loss harvesting, but I can't figure out the rest of his strategy. Yeah. So
you can't figure it out either.
Yeah. But look, tax loss harvesting is a way to show as an advisor that we're creating alpha by reducing the tax burden of a portfolio. The reality is we've lowered your cost basis in the security. So you're going to pick that up later on in the planning process. So tax loss harvesting is not always the best thing to do. Just keep that.
Go up to Michael G's there. He said thoughts on master limited partnership stocks.
I don't see that. Right here, Michael G. MLPs, yeah. I mean, it's like a toll booth, right? You collect some payments every time. Energy is being, there's more downward pressure than upward pressure on energy, but energy is here to stay. Like you need energy to operate, right? And so the one thing I will say on MLPs and anything that is income driven is that you need to look at the total return.
Yeah.
If you look at just the income part of the equation, so total return equals income plus the growth or loss of the investment. If you focus only on income, you could see a 50% loss. Like a lot of people saw a 50% loss on MLPs, but they were still getting their 10% dividend, right? So like you got to look at the total equation.
And the tax consequence. MLPs have what, a 10K or 10K? What, I can't remember, Mar. And I think even an MLP inside an IRA, there's something. It's like it's a lot. And
you get a K1 distribution.
K1, that's what it was. K1.
And remember, with the K1, now there's a K3, right? So even if you get your K1, you can't file until you get your K3.
I didn't even know that. Makes my head spin. All right.
So this is $50,000 per year per family.
No, per family, per lifetime. That's what it says.
But I'm saying they're asking, is it per lifetime? No, it's per year. $50K per family per year, it should say.
What, the Biden plan? Oh, I'm not okay.
Yeah. So the annual gifting would be capped at $50,000 per year. So you can give $50,000 per year.
Gotcha.
Not $18,000 to as many people as you want.
I gotcha. Okay, understood. Gotcha. Right on.
No, IRA is taxed as an IRA. 401k gets taxed as that. So.
No, if you talk about the MLP in there, there's some kind of account that even if you have it inside an IRA, maybe, I don't know what it is. It's like there's some freaking crazy tax structure on that, Amar. It's nuts. I forgot what it was. I had a client who had that. I was like, dude, I can't remember what it was. This guy says we're both smart dudes. Oh, I mean, I am. I don't know about Amar.
All right, we're at half. We went over. All right, Josh.
Good stuff,
Hey,
Amar.
if you guys could do me a favor, if you're still sticking on at this point, there's 67 people I see on the counter. Please go over to Client First Capital Learning, the YouTube channel, hit like on this live stream, and then also subscribe because 90% of the people that we talk to are not subscribed to our channel. So
good
help
stuff,
other
Amar.
people.
And if you guys got ideas, let us know. We're wide open, man. We're wide open. We're a sponge. I'm gonna go feed my dogs because they're chomping out the bit. But we'll talk to you later, guys. Thanks, Amar. We'll see you, man.
Bye now.
All right, see you.
Bye.
Pablo, stop.